Good morning. Welcome to Kenya News Update today. I'm your host, and we're bringing you a special 12-minute deep dive into a development that could reshape the economic landscape of Africa for decades to come. The U.S. African Union Strategic Investment Working Group, or SIWG, is officially underway. This isn't just another diplomatic communique. It represents a fundamental shift in how the world's largest economy engages with the world's fastest-growing continent. For years, the narrative has been dominated by one major player, China. But now, the United States, under President Donald Trump, is launching a direct challenge with a radically different playbook. Instead of building roads and bridges, Washington is bringing its most powerful weapon to the table, Wall Street. Today, we'll unpack what this new U.S.-Africa Strategic Investment Working Group really means for investments, jobs, and sovereignty across the continent. We'll examine the staggering numbers, the ambitious goals, and the fierce debate it's already sparking. Is this the dawn of a new, more sustainable partnership, or simply a new form of economic competition dressed up as cooperation? Let's get into it. Our first chapter, The Great Pivot. For over 2 decades, China's presence in Africa has been physical, tangible, and impossible to ignore. From the standard gauge railway in Kenya to ports in Djibouti and stadiums across the continent, Beijing's Belt and Road Initiative has poured an estimated $2.5 trillion into global infrastructure, with Africa as a central pillar. The model was straightforward. Chinese state-owned enterprises provided loans and built the projects, often using Chinese materials and labor. It filled a critical void, but it also left many African nations grappling with substantial debt and questions about long-term sustainability. Enter the Trump administration's new strategy. Announced in late 2025, the Strategic Investment Working Group flips the script entirely. Its core thesis? Replace traditional government to government aid and concessional loans with private sector-led investment. The goal is to mobilize American pension funds, insurance companies, and private equity to address what the African Union identifies as a crushing infrastructure financing gap. We're talking about a shortfall of between $68 billion and $108 billion every single year. That's not a one-time need. That's an annual chasm that must be filled to power Africa's growth. The SIWG aims to be the bridge, using innovative financial tools, like blended finance, where public funds de-risk private capital, to make African infrastructure projects bankable for U.S. investors. In essence, the U.S. is betting that its financial leverage can outmuscle China's physical footprint. It's a model of capital versus concrete, and its first major test is happening right now. Let's visualize the scale of the challenge. The African Development Bank estimates that to achieve its development goals, the continent needs to invest about $3.4 trillion in infrastructure by the year 2030. That's a mind-boggling figure. But the annual gap, the difference between what's needed and what's currently being invested, sits in that range we mentioned, $68 to $108 billion. To put that in perspective, Kenya's entire national budget for the fiscal year 2024-2025 was about 3.9 trillion shillings, or roughly 31 billion US dollars. So, Africa's yearly infrastructure shortfall is more than double Kenya's entire annual government spending. This gap spans critical sectors: energy, transport, digital connectivity, and water. The SIWG's success hinges entirely on its ability to attract a meaningful fraction of the trillions of dollars sitting in U.S. capital markets toward closing this gap. Proponents argue this is a smarter, more market-driven approach that builds local capital markets and avoids debt traps. Critics counter that private capital demands high returns, which could make essential services like water and electricity unaffordable for the poor. It's the central tension of this new American strategy. Now, to the mechanics. How does this working group actually function? It's a joint technical committee co-chaired by senior officials from the U.S. government and the African Union Commission. Their mandate is not to fund projects directly, but to act as a catalyst and a matchmaker. They identify pipeline-ready projects across Africa, those with solid feasibility studies and clear regulatory pathways, and then package them for U.S. institutional investors. A key tool in their arsenal is the Development Finance Corporation, or DFC, America's Development Bank. The DFC can provide loan guarantees, political risk insurance, and direct equity investments to make projects less risky for private players. We've already seen early movers. In February 2026, the DFC committed $636 million to support a major solar power plant in West Africa. Just last week, a consortium of U.S. and European funds, facilitated by SIWG talks, announced €140 million investment into a pan-African digital logistics platform. These are the prototypes. The working group has reportedly shortlisted $17.3 billion worth of projects in its first pipeline, focusing on sectors like renewable energy, digital infrastructure, and climate-resilient agriculture. The message is clear. The U.S. sees Africa not as a charity case, but as the world's final high-growth investment frontier. But no strategic shift of this magnitude happens in a vacuum. This brings us to our debate segment, the geopolitical chessboard. There's no avoiding the fact that the SIWG is a direct response to China's dominance. For 20 years, Beijing has enjoyed largely uncontested influence as the builder of Africa's foundational assets. This U.S. move signals that the era of uncontested influence is over. We're now entering a phase of explicit great power competition on African soil, but fought with different weapons. China offers turnkey infrastructure projects with speed and scale. The U.S. is offering capital market sophistication and, crucially, a narrative of sustainability and transparency. President William Ruto of Kenya has been a vocal advocate for this shift, emphasizing the need for investment over debt. In a speech last month, he stated, quote, "The future of Africa's development will be written by private investment, not sovereign debt. We welcome partners who see opportunities, not obligations." End quote. This aligns perfectly with the SIWG's philosophy. However, analysts in Beijing have been quick to dismiss the American approach. One commentator in China's Global Times called it portfolio manager diplomacy, arguing that faceless Wall Street funds lack the strategic patience and understanding of African needs that Chinese state-backed projects possess. The risk for African nations is becoming a passive battleground. The opportunity is to leverage this competition to secure better terms, more technology transfer, and genuine partnerships. As Dr. Ngozi Okonjo-Iweala, Director General of the WTO, recently warned, African leaders must be the masters of their own development narrative. Competition for investment is welcome, but it must be on terms that build local capacity and create jobs for African youth. Let's ground this in a local context. What could the SIWG mean for Kenya? Kenya has positioned itself as a financial and tech hub for East Africa, making it a potentially prime beneficiary of this capital-focused approach. Projects like the Nairobi-Nakuru-Mau Summit Highway, which requires significant private investment, or the ambitious LAPSSET corridor, could be repackaged to attract U.S. institutional money. The government's own infrastructure bond program, which has seen mixed success, could get a major boost if U.S. pension funds begin allocating even a small percentage to Kenyan paper. However, there are significant hurdles. U.S. investors have stringent requirements on governance, environmental impact, and financial returns. Kenya's recent battles with corruption scandals and a volatile shilling could be marked as red flags in risk models. Furthermore, the preference for private capital could sideline crucial social infrastructure, like public hospitals and schools, that are not traditionally profitable. It raises a critical question. Will this model only fund projects that generate dollar returns for foreign investors, or can it be shaped to serve broader public goods? The Kenya Private Sector Alliance has expressed cautious optimism, noting that aligning with global capital standards could improve the overall business environment. But civil society groups are wary, pointing out that when essential services are privatized, the cost is often passed on to consumers. The true test for Kenya will be in the negotiation rooms. Can its technocrats structure deals that attract the capital while safeguarding national interests? Looking ahead, the path for the SIWG is fraught with both promise and peril. On the promise side, if successful, it could unlock a historic flow of long-term capital into Africa. It could help develop local stock and bond markets, create a new asset class for global investors, and fund the green transition. The initial target is to catalyze $55 million in early-stage project preparation funding to get deals to a bankable state. This patient capital for preparation is often the missing piece. On the peril side, the global macroeconomic environment is challenging. With high interest rates in the U.S., investors are more risk-averse. Political instability in several African regions remains a deterrent. And perhaps the biggest question, will U.S. political commitment survive beyond the Trump administration? Strategic initiatives often fade with changing presidencies. The African Union, for its part, must ensure this working group doesn't become a talk shop. It needs to deliver tangible financial closures, and quickly, to build credibility. The next 12 to 18 months will be critical. We should watch for the first major financial close of a project that was directly shepherded by the SIWG. That will be the proof of concept. Until then, it remains a powerful idea in search of execution. In conclusion, the launch of the U.S.-Africa Strategic Investment Working Group marks a definitive turning point. It is the clearest signal yet that the United States is engaging with Africa through the lens of global capital markets, not just geopolitics or aid. This shift from concrete to capital presents African nations with a new set of tools and a new set of choices. The potential rewards are enormous, sustainable funding for the infrastructure that can power economies and create millions of jobs. But the risks are equally significant, including the potential for cherry-picking only the most profitable projects and exacerbating inequality. Ultimate outcome won't be decided in Washington or Beijing, but in African capitals like Nairobi, Addis Ababa, and Abuja. It will depend on the capacity of African institutions to negotiate complex financial deals, to regulate effectively, and to ensure that incoming investment serves a national development vision. The era of passive reception is over. The SIWG, for better or worse, demands active, sophisticated agency from African leaders. The working group is on. The table is set. Now, Africa must decide how to play its hand. For Kenya News Update today, I'm your host. Thank you for watching this deep dive. Subscribe to Kenya News Update today for more incisive coverage of the stories shaping our nation and our continent.